Welcome back to the Miami Real Estate Podcast powered by Cervera Real Estate. Today, we have your economic insights with Dr. Marci Rossell, Chief Economist, leading real estate companies of the world.
Guys, it's the last economic insights of 2024. Big news actually today was we just in the last couple of hours had the most recent jobs report drop. So I want you to walk us through that, especially in light of this one feeling a little bit momentous to a lot of folks who are the Fed's watchers and know that there is a Fed meeting coming up mid-December, December 17th and 18th, and everybody's kind of wondering if we're going to see, some activity from them. So Marci.
Right. So it is the first Friday of the month. And for those of you who sort of follow the economy, you know that the first Friday of the month is always when the employment numbers for the prior month are released. So we got an employment report this morning, and it was a little stronger than what folks were expecting. And so we saw job growth return to over 200,000 jobs a month. And we saw a revision to October, which was also significant. So the October numbers were really weak and everybody was like, oh my gosh, labor market's cratering. But then there was a revision up. So job growth kind of has continued. But I want to remind everybody of something. These job numbers are always subject to pretty big revisions. So we put a lot of focus on one number. But if you read really carefully down into the reports, what you'll see is there's basically about 100,000, a confidence interval around this number that's 100,000 in either direction. So basically what they say is we know we're off somewhere around 100,000 jobs in either direction. So I always caution everybody when it comes to monthly numbers, don't make too much of them, right? That they have some information, but they're subject to revision. And by the way, the revisions happen because this is statistics. And they use incomplete survey data to get a number out quickly. And then they go back and use bigger, better data sets to get a full picture of what's going to happen. So a lot of people sort of when the revisions were released earlier this year, you might recall, we talked about this about 3 months ago, there was a huge revision to all the numbers and everyone sort of was screaming that the Bureau of Labor Statistics might be trying to mislead people. And they don't do that at all. They are very clear in their reporting that these numbers are subject to very large revisions. And even though the revisions from this year have been big, they aren't the biggest ones on record. But we do know that the revisions tend to be large when the economy is shifting. So if the economy is getting really strong, we tend to undershoot the numbers. And when the economy is weakening, we tend to see big downward revisions. So I'm just sort of cautioning everyone about those numbers. So yes, we got an employment report today. Unemployment rate is still elevated above 4%. And you may ask yourself, well, how can you have job growth, but the unemployment rate keeps going up? And that happens because people are coming into the labor force. So what we're seeing are very slight upticks in labor force participation rates. So you can have job creation, but if the job creation is slower than the rate at which people are entering the labor force, then the unemployment rate picks up just a little bit. And that's kind of the world we're in, where I would say that labor markets have kind of fully normalized to the post-COVID reality, where anyone who wasn't in the labor force because of COVID-related issues, they had childcare issues, maybe they left their job in hospitality and were retraining to go do something else, all that's done now. And that's why you're seeing labor force participation numbers pick back up to where they were prior to COVID, and it's causing that unemployment rate to tick up. But 4.2%, not a big number by historical standards.
So how are the Feds going to read this? What can we expect?
Well, the Federal Reserve's full of economists just like me who say that one month of numbers is not that big of a deal. So I think that the Federal Reserve is looking beyond the labor market to other developments, particularly around long-term interest rates and inflation. So they kind of, and this is sort of skipping ahead to the outlook for next year. So I kind of,
don't steal your own thunder.
We steal my own thunder. But I don't think they'll put a lot of weight on this number at all. There's no big information there. It's not telling them that labor markets are any stronger or any weaker than what they thought.
So, are we going to do a year in review, Marci? Shall we?
So this is something that I thought we could kind of start doing, something that's sort of useful in December, because to set the stage for where do we think the economy is going next year. I always think it's super helpful to just say, well, what happened over the last 12 months? Because economies tend to be full of trends, basically. And generally, whatever happened yesterday is the most likely thing to happen tomorrow when it comes to the economy, or quite frankly, pretty much anything else, right? So trends are extremely important from that point of view. So depending on what the economy's kind of momentum is, it's important to sort of note that every once in a while. And so I just put together kind of a really quick summary of indicators, things that I look at that are kind of useful for saying, okay, what kind of year did the economy have? So Jessica's going to throw that up right there. This is 2024, the year in review from an economist's point of view.
With Christmas sparkles.
That's right. With Christmas sparkles, right? Got to have sparkles just that time of year, right? So what I did was just put together a quick and dirty sort of, here are a few indicators that matter to all of us. And in gray, you'll see a little strip of numbers. And those gray numbers are where the numbers stood at the beginning of this year. And then I have the most recent updated numbers for where are we currently right now. And so if the number is green, that means it improved. And if the number is red, that means it got worse. So this is kind of, it was a quick way for me to sort of get a read on, was everything better? Was everything worse? Or is it kind of like life and a lot of things where some things are better and some things are worse? So with that, let's go through just number by number and kind of comment on each one. So at the very top line, you've got U.S. gross domestic product. Now, just to review for everybody, gross domestic product includes everything that gets produced in the United States in a given year. So it includes consumer spending on all sorts of things, tinsel, books, jackets, earrings, all that stuff, right? So that's the sort of where what GDP is. All the things that get produced, cars, refrigerators. It also includes business investment. So when businesses buy new printers, they buy equipment, all those things. It also includes fixed residential investment, right? So home building gets included in this number as well. It's got government spending in there. It's got exports, so all the things that we make and send to other countries. But then you subtract away all the things that we buy from other countries as well. And that gets you U.S. GDP. It started out the year at $28.3 trillion. It now stands, by the end of this year, it should be, and this is an estimate, $29.7 trillion. So $1.4 trillion extra in GDP. So economists call this a win, right? Because remember, the whole point is just to produce more stuff. Now, the unemployment rate, if you look at sort of labor markets, something that people are sensitive to, the unemployment rate picked up from 3.7% to 4.2%. So this is why the Federal Reserve has been cutting rates. Because if you look at inflation numbers, they went from 3.1% to 2.6%. So inflation went lower, but the unemployment rate ticked up. So the Federal Reserve basically said, hey, the Fed funds target rate, which was at 5.25%, a really high rate, we're going to cut that to 4.5%. And everybody recalls their first rate cut. It was a big one, right? It was 50 basis cuts. They cut rates another 25 basis points. We'll talk about where they're likely to head in just a few minutes when we get to next year. But I just want you to know where we stand right now. Now, if you look at the budget, the government budget deficit, that's what I termed budget balance. So I express it as a percentage of GDP, because if I just throw a number up there like 4 trillion or 5 trillion, it's not meaningful. But in general, most folks agree that your deficit as a percentage of GDP needs to stay below 5%. So if you're following developments internationally and sort of watching what's going on in France right now, Parliament threw the guy out. basically because they were attempting to come up with a budget for next year, having some difficulties doing so. And the main reason, of course, is that their budget balance as a percentage of GDP has been running a little high over that 5% number. They're trying to get it down, having trouble agreeing on exactly how they're going to do that. Sound familiar? Sound like something that's probably going to happen in the United States of America in the next couple of months as well. Because our budget balance, which was running at 6.2% of GDP at the beginning of this year, has ticked up to 6.4% of GDP. So basically, you can kind of see that number is elevated, needs to come down, and will be the source, I believe, of much discussion over the course of the next year. Now, that gets us to housing markets. I just threw up sort of mortgage rates and existing home sales because mortgage rates, which had been trending down in September, October, have now begun to trend back up. And I believe that that's a reflection of folks expecting higher inflation and higher interest rates next year. Because remember, interest rates move in anticipation of future events. So financial markets tend to be the first thing that reacts to any kind of change in the environment. And so we have seen since November, since the election, mortgage rates have increased. Long-term interest rates have increased from where they were pre-election. This, of course, has had a pretty dampening effect on existing home sales, which were running at a 4 million rate at the beginning of this year. And the latest number we have is slightly down to a 3.96 million rate. So those bad news for the housing market, obviously, at least looking backwards. We'll talk about the outlook in just a moment. But before we can talk about the outlook, let's note what's happening to the stock market. Because I believe the biggest story of the past year is that the S&P 500 has gone from less than 5,000 to over 6,000 over the 12-month period of time. So as you guys have heard me say before, I believe financial markets are the best place to look for a forecast of what the next 6 months to a year is likely to sort of look at. And that's why I finished the year in review with what has happened to U.S. stock prices. Now, this was just a snapshot of what's happened in the U.S. And I realized sort of for my international friends out there, this might be a little bit unsatisfying because I didn't sort of take a trip around the globe, which is something maybe we can do in January. But in that, the world has really been sort of focused on the U.S. elections and what the incoming administration is likely to mean for the U.S. economy and for the rest of the world. That's kind of why I stayed U.S. focused, and I'm going to stay U.S. focused when I talk about the outlook, but I'll touch on what it might mean, particularly for those countries who are export dependent when it comes to things like tariffs and all that kind of stuff.
Yep. Do you want to do it? Do you want to do the year ahead? All right. We got a slide for you guys on that too.
We've laid the groundwork. We're all on the same page. So mixed bag for the economy in 2024, just based on my red and green kind of scale. So I carried that red and green scale over into the outlook for 2025. Now, this is an economist speaking, right? So I'm not talking politically. I'm not talking socially. I'm simply saying from an economist, how will this affect the nation's well-being? And I'm U.S. focused at this point, but again, we will touch on the international outlook as well. So I finished with the S&P 500 and the big gain that it's made, particularly in the last couple of months, because it's my belief, and if you read anything about this, everybody sort of understands that the possibility of corporate tax cuts and significant deregulation, those things are highly likely to occur because it's pretty easy for the new president to cooperate with Congress, which is dominated by his own party, to pass legislation that will extend those 2017 tax cuts, maybe indefinitely, who knows, and perhaps even lower the corporate tax rate even further. So those things, financial markets, I believe, are suggesting are highly likely. given the rally in stock prices and given the effects that that is likely to have on corporate America. Because some recent research has been done by economists who have suggested that basically, if you look at the stock market gains over the last 20 years, they've really been driven primarily by lower interest rates and lower taxes. Now, let's talk about what this might mean for the housing market in particular, because those tax cuts will likely include an extension of the lower tax rates on your highest income earners. Now, those tax rates have been in place for the last 5 years, 6 years, basically since 2018. It's a 2018 tax year, but people were expecting them to go away. Now that we know that they are very likely to be extended at least for the next 4 years, what we will see is basically a boost to the luxury buyer in particular. So this means for folks that make, for every $1 million in income, basically 1 percentage point decline in their marginal tax rate is $10,000 to their bottom line. So any extension of those tax cuts, which folks were expecting to go away, is a boost to your highest income earners. So the tax cuts really boost the luxury buyer. That's number one, because just the sheer amount of money is going to be sort of disproportionately benefiting the highest income earners. So tax cuts boost that luxury buyer. Deregulation continues to fuel the stock market, maybe in ways that become more apparent as we move into 2025, 2026. And so that's another boost to your luxury buyer that's going to have a greater percentage of their wealth in the stock market than lower income buyers and first-time buyers. So I'm sort of doing green for tax cuts and deregulation, but understand that it disproportionately will affect your highest income buyers. Which gets us to sort of the third economic development that folks are expecting in 2025, and that is the imposition of larger tariffs on Mexico, Canada, China, all of our trading partners. Now, I got to tell you, the numbers that have been thrown out there, I don't believe are particularly relevant at this point. So I'm not going to say that I'm expecting an additional 60% tariff on Chinese goods, because the truth of the matter is there's less of a baseline in some ways for kind of understanding a fixed point of what's likely to happen. It's all subject to negotiation and politics, but certainly there are going to be higher tariffs next year than there were. We just don't know by how much. If they're too high, I think the stock market would have been adversely affected, right? 60% tariff on Chinese goods would hurt everybody. So it probably won't be that. But the bond market also reacted by raising longer term interest rates, which suggest that the bond market is expecting some inflation that feeds into higher long-term interest rates and fewer Federal Reserve rate cuts on the short end as well. So this means the decline in interest rates that we were all expecting back in the summer is kind of off the table. This is tough for your first-time buyer who doesn't have cash, right? So your luxury buyer, they got cash from the stock market. They've got cash from the sale of their last house. They aren't as interest rate sensitive. You guys all know that. But it also means that the lock-in effect, particularly for your starter homes, lingers. So it's slowly rolling off. The lock-in effect that took hold when interest rates went up in 2022 and 2023 dissipates over time because life gets in the way, as we've sort of commented over and over and over again. But higher than expected interest rates just make it linger a little longer than what we were expecting. which gets us to the final sort of piece that, again, has a lot of uncertainty around it. So I've kind of listed these from most certain, tax cuts, deregulation, to less certain, tariffs and escalated deportations. So escalated deportations, it's not really clear what's even feasible. In the first Trump administration, basically about 40,000 escalated deportations occurred in every 3 months when Trump first took office in 2016. So that means 120,000 additional deportations, because deportations are happening all the time. This is just an escalation of it. Now, the administration has promised more, but the reality of carrying that out remains to be seen. So it's a pretty uncertain. Are you going to be able to exceed 120,000, 500,000, a million? Who knows at this point? But we know even a slight increase in deportation means tighter construction labor. It means tighter labor for agriculture, but we're talking about construction in particular, which means there's no relief for inventory. So home building will become even more constrained than it already is. And so, again, this is sort of conspiring to a bottom line of what I would feel is kind of a bifurcated market for next year, where there's sort of, and it's, by the way, it's always true. Luxury buyers and first-time buyers and kind of the spectrum in between always face different circumstances. But I think it's heightened this year based on all of the factors that I have laid out sort of in my outlook for 2025.
So amazing. I love this. We need to make this an annual thing. So guys, I want to talk a little bit about sort of the implications globally. I know we can't go country to country. I wish we could. Maybe we can figure something out for January. But right now, let's talk about global implications given the picture that you just painted.
So we had sort of suggested before that the Chinese economy is slowing already. They're struggling. They have an enormous real estate crisis on their hands, and tariffs will hurt U.S. consumers who will face higher prices. But if we face higher prices, then obviously we will curtail our purchases. That's just basic economics. And so any kind of decline in U.S. buying from China, even if it shifts production to places where the tariffs are lower, like Vietnam, Bangladesh, parts of Africa, right? You could see some movement of production out of high tariff China and into some lower tariff, areas. That's a possibility, but that takes time, right? The immediate effect is just going to be less buying from China, which hurts the Chinese economy. And I think we're at a time from a geopolitical point of view where you really want to be careful with that, that you don't want to give the Chinese nothing to lose, so to speak, when it comes to geopolitical developments. And that economic relationship is one that at least continues to sort of tie us together diplomatically and give us some leverage over geopolitical events. But that's kind of stepping outside of my economist realm. So I'm just going to sort of leave that where it is. Now, China isn't our biggest trading partner. Our biggest trading partners are our neighbors to the north and the south. And certainly higher tariffs mean that production will be pressured to move back into the U.S., but the U.S. faces pretty dramatic labor constraints, particularly if we're in the process of deporting. That's a new word. Deporting, right? Particularly if we're in the process of shrinking the labor force even farther through deportations. So certainly our actions, right? We know the cliche, the U.S. sort of catches a cold and the rest of the world catches the flu. The implications of all of these things for our brothers and sisters around the world are significant. They certainly are. And we will monitor them as the year goes on.
And guys, I have to say, Marci has agreed to be with us through 2025. Economic Insights continues on a monthly cadence. That sounds like some good news to end on to me.
Let's do it.
Appreciate you so much, Marci. We will see you and all of you. We're getting a lot of thank yous in the audience to you, Marci. Thank you all so much. Happy holidays. Lots of joy, lots of success, and hope to see all of you in person very, very soon.